Welcome to TheoTrade. This is Don Kaufman, May 15th, 2020. Doing the weekend update here with about 10 minutes left inside of this Friday's trading session. Is big tech on the ropes? You know, we're going to explore quite a bit, obviously, about the technology sector, but there's also a tremendous amount of data that has come out this week. And, well, the bears, they're everywhere. I mean, how many different hedge fund managers and so forth did we hear about in discussing their bearish takes in the marketplace? Literally too many to even start to mention names. But let's get down to work because, again, there's some big questions left in this week of trade. One of the things, of course, is it's about big tech. This is the first week that we saw any degree of weakness inside of big tech. And when I'm talking about big tech, and I'll come back to this here in just a few minutes, specifically, there's a symbol that we created called the monsters of tech. And the monsters of tech, it's Facebook, it's Apple, it's Microsoft, it's Google, it's Amazon. Some of the first signs of weakness, but slightly bid back up here towards the end of the week. Nevertheless, we're going to be discussing a little bit about sector rotations here momentarily. Before I get that, let's talk about the bears. As I said, everywhere you look, I mean, literally everywhere you look, everywhere you read in the financial markets, another either major hedge fund manager and or, Fed. I mean, the Fed themselves are bearish. In fact, GDP, this is one of the quotes from the Fed this week, GDP could decline by 42% in the second quarter, according to the Atlanta Fed. The reason I'm talking about this is not to promote in any way, shape, or form some of my own, bearishness in the overall marketplace. In fact, I'm not necessarily bearish in the entire marketplace. I'm extraordinarily sector specific, and one of those sectors happens to be none other than tech. In fact, I want to do quite the opposite. Rather than give you a big bearish take, okay, what I want you to understand in the first few minutes of this weekend's update here is that fundamentals, okay, are completely non-existent. That this marketplace, it's about two things, okay? For me, it is about the Fed. It's about the Fed and pumping liquidity. Should we call it liquidity or an absolute crutch into the marketplace? And the other aspect that this marketplace is about, okay? So obviously we've got the Fed pumping liquidity. The other one, it's about the quants. And you're like, whoa, what do you mean the quants? Okay, the quants. And the quants are really running, okay, the show with the along with the Fed. And that's exactly what I'm going to explain here momentarily. So let's get down again to a couple of details here as the market's just wrapping up on the day. We can start with initial jobless claims. The initial jobless claims again this week were over like 3 million, just around the 3 million number. We're 36 million, jobs and counting. That's the initial jobless claims. The next picture over here, the next picture is just absolutely hideous. That comes to retail sales. Retail sales down a staggering 16.4%. Now, the expected was about 12.3%. They actually came in at 16.4%, but that's not the number. Most people miss this. The total spending down year over year, 89.3%. Shockingly bad. So with that, before I go any further, this is where I wanted to show you the disconnect. Okay, and this is why I say, there's not a lot of fundamentals in this marketplace. I'm actually going to start with none other than, in this case, Best Buy. Okay, so we're actually going to go in here and we're going to type in Best Buy, and we're going to look at Best Buy on a year-to-date basis. So Best Buy right now is actually down by the tune of just about 9.6% year-to-date basis. Okay, then I'm going to go ahead and throw in JW Nordstrom's, okay, JW Nordstrom's. We're going to get that right, down about 58%. Now, time out for a second. Why am I talking about a disconnect right now? Well, the next area is going to explain precisely that. So what you're looking at right now is retail store sales by category. This is provided by none other than CNBC. You know what? They did a really nice job actually of putting this together, and I like to give credit where credit is due. If you look at non-store retailers, okay, this is where your online sales. This is one of the reasons Amazon's been performing relatively well. Building materials and garden equipment. That's going to include stuff like Home Depot. In fact, I want to highlight just that. That's your Home Depot over there. Your Lowe's, by the way, Home Depot has been staggeringly good performance. Okay, and we go down the list over here. But the point that I wanted to make is you start to look at like electronics and appliances, you realize that their sales are actually down some 60%, and Best Buy is technically in that category. Of course, immediately people go, no, Best Buy is all online sales. Really, because Best Buy doesn't even see it that way. All right, and again, I can go on and on. If you look at clothing and accessories, down some 78%, but is the marketplace damaging them to that extent? The answer is, well, JW Nordstrom's only down 58%. And again, I wanted to throw Home Depot in here. So Home Depot actually looked like it's actually down. No, on a year-to-date basis, it's up 9.3%. And again, I deviate to this. You take a look through individual stocks that fit into different categories over here, and we are completely and utterly disconnected. And that's the point that I wanted to make early on with looking at things like initial jobless claims, with listening to people like, David Tepper came out and he's like, this is the biggest overvaluation I've ever seen. None of that crap matters because there are no fundamentals in a marketplace, all right, that is buying corporate bonds, all right, that's giving, capital to, you could be a degenerate borrower and you're still going to get money right now. And that's one of the key points over here that I was trying to make by pulling up Best Buy and JW Nordstrom's. You could look at, Bed Bath & Beyond and Costco. I mean, come on, you have to bring up Costco in this. Costco themselves, okay, throughout the course of the week, they stated that their foot traffic is down and down substantially. Stock still up 2.4%. By the way, okay, want to clarify, I am actually in a short position in Costco. I am in a short position inside of Walmart. Neither one of those are treating me very well, but I'm also in a short position inside of Home Depot. There's one last aspect I wanted to face in this one, and that's J&J. J&J is actually up also about close to 3%. But right here on the top of this, we start to talk about health and personal care, which is actually a huge portion of J&J. Even J&J is surprised right now because their sales have been off that substantially. Nevertheless, I don't want to deviate too much. I just want you to understand the disconnect between, you're looking at a marketplace in the S&Ps and you're thinking to yourself, this is just insane. That's okay. It can be insane all at once. There can be a massive disconnect, all right? There might not necessarily be fundamentals. And I think that we have to all, in this next decade of trade, you need to push the idea of fundamentals out of your head. There are still some stock buybacks going on. There are quantitative traders that are actually doing sector rotations, which I'm going to cover here momentarily. That's, along with the Fed and cheap money and degenerate borrowing. I mean, listen, Elon Musk, even he can get a loan these days. It really distorts what you classically think of as a marketplace. And once we recognize that, and once you recognize, that the record number of brokerage accounts, I was talking about that last weekend, record number of brokerage accounts that have opened in the last quarter. Most of those opened up in March when all of this was unfolding, okay? And you start to realize how markets can rally in the face of this. Next, we move on to the monsters of tech. So, I was talking about big tech, and big tech showing what? Degrees of weakness. Big tech could possibly be on the ropes a little bit over here. And I created this kind of monstrosity symbol to, really elaborate upon much more about 5 companies that pretty much run the roost. What you're looking at, with this is, it's the biggest and the best, obviously, of the NASDAQ. It's the biggest market cap out there. They faded early in the week. They rebounded. Okay, how much do they rebound? To give it a fair shake, to give it a real fair shake over here, I'm going to go to the QQQ. I'm going to actually go to the Qs. Okay, and I want you to see how much they rebounded by looking at auto expected moves. So what we had actually done throughout the course of this week in big tech, all right, on Wednesday, we cracked well outside the expected move. On Thursday, we came back inside of it, okay, and net on the week, we are absolutely down on the week inside of the NASDAQ. Big tech, specifically the monsters of tech, fared a little bit worse than the NASDAQ did as a whole. But at this point in time, this has really raised a lot of questions because tech weak and it's threatening to kind of break apart. All right. And I cannot stress this enough. And we're talking about sector rotations. In several trading days today, we're not necessarily seeing that today, but in several trading days this week, we've actually seen, okay, reverse sector rotations. And what I'm talking about, all right, is specifically, all right, on Thursday. This is actually the financials. Capital came rushing into the financials and was actually coming out of technology. It was only later in the day that technology picked back its head just a little bit. So there is a chance, okay, that we start to see, again, sector rotations kind of reversing. Now, before I go any further, those sector rotations, and we're going to come back to a little bit of the range and so forth, but I want to kind of enunciate a little bit about some of those sector rotations because it's such a critical part of this. Sector rotations are reversing, and we're talking about the Russell and the XLE and the XLF in tech. Okay, those are your big sector rotations. So let's actually dig down specifically into the sectors and sectors that matter. All right, lately what we've seen, okay, happens to be the XLF, okay, moving in relative concert with the energy sector, which is the XLE. So those two have been moving in relative concert. Along with it, they've actually been dragging in most days the IWM. IWM is a little bit of the odd product out today. It's up and it is up big. There's the closing bell today. But I'll come back to that. So here's actually a sector rotation where we're moving capital from financials, we're moving capital from energy, and we're shifting towards technology. These rotations have been much more pronounced in recent trading sessions. We've actually seen, okay, the XLF, which again is your financials, along with your energy sector, having massive moves. In this particular case, here's the XLF. You can see some big moves to the downside, along with energy moving to the downside, and that capital kind of rotating out of the marketplace. Well, this week we actually saw towards the end of the week it reverse, okay? And that reverse actually was bringing capital back into the XLF and pulling out of the monsters of tech. Again, on this Friday afternoon, a little bit of deviation, per se to that. Nevertheless, look at these rotations carefully. And it's confusing. If you're live on TheoTrade on a day-to-day basis, you totally get it. Because we've been watching this on a day-to-day basis. We're like, hey, look at the rotation going on. They're getting out of financials. They're getting out of energy. They're getting out of the IWM. And they're headed towards tech. Well, those started to reverse. And you got to watch it. Because you have to recognize if tech goes, we all go. I mean, this is a marketplace of correlations. And this is a marketplace that day in and day out has been heavily correlated. Today, there's something actually quite ironic as I talk about correlations. Every day this week, we've been seeing 90-10. If we went up, 90 stocks were up, 10 stocks were down, and that's in the S&P 100. If we went down, 90 stocks were down, and 10 were up in the S&P 100. Today, we end the day with a 50-50. That's why I'll tell you right now, okay, I wouldn't trust this little bump to the upside today as far as you can throw it. I'll explain that here. Now, the next thing actually to bring up, so tech. You're going to watch tech and you're going to watch it carefully. If tech starts to go, what's going to happen is you're probably going to see an initial rotation into the financials. But then if tech starts to go and go big, it's going to do the exact opposite. It's going to snap the back of the financials. Now, on the flip side of that, we're going to talk about this range. The range, it's still with us. Okay, we're in a volatility box. Now, I can show the volatility box in the spiders. I can show it in the XLF. Once again, I'm going to detail a little bit about the volatility box because it's such an essential portion. Okay, and if you think I've talked about this ad nauseum, you're right, I have. So that volatility box, we've really kind of cracked down and narrowed it down. All right, inside of the volatility box, the one thing we've learned about it, you could be to the upside of it, you could be to the downside of it. We'll call the upside right around that 295 level. The downside, I think, is even better defined this week at about 275. Yeah, I was thinking it was closer to 270, but towards the end of this week, 275 is actually spot on. Where are we right now? Smack in the middle of it. The one aspect is earlier this week, we're ready to break to the upside of the volatility box, except 2-3 days later, we're ready to crack to the downside of the volatility box. I cannot stress this enough. It's a complete and utter, binary position at this point. Whether we crack higher or lower, all right, you're on a 50-50 bet over here. And this is where you really have to maintain very, very constrained with your allocation. Because the longer we're in the range, the more violent the break is going to be. Again, we keep propagating more and more and more and more risk in here. And when we snap, it's going to be a violent move. And I this is where everybody's like, what do you think we're going to do? Why do you think I'm watching tech and the sector rotation so much? Okay. The other question you have to ask yourself is, why are we trapped in a range like this? Like, what's going on with the S&Ps? Everybody looks at tech and tech keeps going up, right? So if you take a quick glance at tech, and here's the NASDAQ. The NASDAQ is not trapped in a volatility box, okay? The IWM, it's almost breaking to the downside over here a little bit. And if you start looking at the XLF, the financials actually did break to the downside. So they're not necessarily in a volatility box. You're exactly right. You're getting financials weak, tech strong, and the S&Ps are skirting right through the middle of it. But there's a larger thing in play here. And when I say a larger thing in play, all the asset classes are pretty much, the big asset classes are all in this box. So yeah, just a moment ago, I'm examining, the S&Ps a little bit. And again, be constrained with your allocation. If there's one takeaway from here, because when we break, it doesn't matter whether you're bullish or bearish. If you're on the wrong side of it, everybody gets their head taken off that's on the wrong side of this move. And I can't reiterate that enough. All right. And you know what? Like half of you are going to be on the wrong side. Don't tell me everybody's bullish, because right now everybody seems bearish. So we may have to break to the upside to eventually resolve lower. We'll see. All right. But that range is with us. But that range is everywhere. It continues to be inside of the bonds. But the bonds all of a sudden, okay, I would even have this down below. The bonds are starting to come back to life a little bit. I'll detail that again more in just a moment. Nevertheless, when you start to look at that, look how tight the range is inside of the bond product, right? We'll come back to the bonds in a moment. If you take a look at gold, so we can mention gold. Again, all your major asset classes, your major commodities. Gold. I know what you're thinking. Gold broke out of the top over here. Yeah, it did until it actually pulled right back today. It's just at the upper edge, okay, of that kind of volatility box. Then you can obviously look at the spiders because we've already brought up the spiders ad nauseum. Of course, you can look at the dollar. Okay, I think the dollar is also critical in this. The dollar is becoming like the new VIX. If you look at the dollar and gold, they're both threatening to the upside. If you look at bonds, they're now threatening to the upside of the volatility box. Yet at the exact same time, the S&Ps were threatening to the downside. So that range is still with us. Okay, remember, I'm telling you this. Okay, the longer we're in the range, the more violent the break. And we are ripe, people, ripe for a break. So I'll come back to the bonds for just a second because I wanted to reiterate one quick comment about the bonds. As I said, they were trading towards the upper edge of the range. There are signs of life back in the bonds. There's volume spikes coming back over here. I mean, I really feel like, the bonds have been in pretty much cardiac arrest for the last couple of weeks. The Fed grip hold of them. Right in this neighborhood here, they completely flattened out. Finally, we're starting to see some signs of life. When the bonds come back to life, forget it. The S&Ps are going to be rocking once again. So cannot stress this enough, where you have to watch the bond product because the bonds on their own can actually snap the back of the S&Ps. Why? Because this is where institutional traders are getting their business done. The only problem is the institutional traders, they haven't been doing anything in the bonds lately. Okay, but they're going to come back. When they do come back, things are going to get, once again, Mr. Toad's wild ride. We're actually going to take a quick glance over at the volatility complex. If we take a look at volatility, the 33-day volatility is, basically at par with the 68-day volatility. They're even, all right? But we are still fading very slightly in some of the back months. Effectively, what I'm still saying, there's still more risk right here, right now, than there is out in the future. The other thing that I think is worth mentioning on this particular front, the VVIX. The VVIX is all kinds of lighting it up this week. I mean, the VVIX is back to like the 132 level. That means institutional traders are out there hedging. Now, I know what you're thinking. Okay, in this weekend's update, I'm not spending a tremendous amount of time talking about individual stocks because there is no individual stock. There is no tomorrow. No, there is no individual stock when we're talking about highly correlated asset classes. Okay, just because Microsoft was up today, well, great. Apple had some news on it, but you have to look at the monsters of tech as a whole. You have to look at everything right now as a whole because when all asset classes start moving in relative concert, that's when things get dangerous. And right now, when I say the quants have kind of gripped hold of this marketplace, you know what quants do? Okay, quants are heavily involved in this stuff like sector rotation, where they're moving out of the financials and they're moving into big tech. But sooner or later, that's going to unwind. They're going to come out of big tech. And when they come out of big tech, I will be waiting. Now, when they come out of big tech, it's going to get violent in this marketplace. Then we start to crack the range and it's all over. Now, SPX, there is one interesting thing going on right now inside of the SPX. So 11 out of the last 18 weeks, we've seen moves outside the expected move. But if you're taking a look at the SPX and you're wondering like, wow, I talked about this specifically in Wednesday night's video, okay? This week would be defined exclusively by this level right here, basically 2850. The 2850 happens to be the lower edge. Again, that is the lower edge of the expected move for the week. So right there, what I wanted you to see, okay, is that we pulled literally back to the edge of the expected move, stopped pretty much on a dime, trickled above it here in the after hours. In fact, quite ironically, we're basically on the edge of the expected move in the after hours. The marketplace dribbled a little bit lower here. We're just about 8 minutes after the cash close. The market's literally pulled back to the edge of the expected move. It's important because what we're seeing is in the midst of all this chaos, the marketplace is now starting to once again adhere to the SPX, of which, okay, you had an expected move this last week of $79.60. Now, we cracked through that $79.60. And you can see today's trade amounted to a whopping $11 move. What are we looking at for next week? Next week, net, we're looking at somewhere around like a $91, $92 move. So once again, all right, we're coming into a heavy volatility week. all things being equal, though, and I find this kind of interesting, the volatility in this next week of trade is quite considerably more than it was in the previous week. So this is last week. Last week we had a $79.60 expected move. The actual move was almost spot on. So this next week now we're looking closer to a $92 move. And you're like, who cares? It's $92. I'll tell you why you should care about that, because you're going to be coming very close to a holiday weekend. And coming into holiday trade, how come the volatility is so high? Because a lot more news is going to be breaking. All right, listen, there's a huge amount to think about in this, weekend's update. But again, big tech, it's what to watch. It has been what to watch. Normally I'm very centric to the financials, but if you talk about the financials, listen, the financials, we already know where they are. They've broken lower. The financials have actually broken, the bottom, if you will, of their little volatility box. And the financials, they're right out here. And I got to tell you, I've got positions specifically built in the financials. What happens if the whole marketplace rallies to the upside? The financials are going to burst to the upside as well. So what have I done in the financials? I have big time call ratio back spreads right in here. And I put those in there in case the financials rip to the upside, the S&Ps rip to the upside. I have to actually hedge, the negative delta. Where's my negative delta? And I've reiterated this week in and week out. All right, I got positions in Intel. I've got positions in Home Depot. I've got positions in Microsoft, Facebook, I now have a position in Apple. These are short positions. And again, I'm specifying my short positions right now. So we're actually in Microsoft and Facebook and Apple and Intel and Home Depot, short position in Costco, short position out in Walmart, short position in XLP. I also have some long positions. My long positions are very specific. Those are actually something you can track over at, in TheoTrade, and I'll take you into there in detail. But to hedge much of these, and much of these negative deltas, which they are, I'm actually using back ratio call spreads inside of the XLF. Because again, if the S&Ps are going to pop to the upside, the S&Ps in very large part are going to be led by the financials. So this isn't about, putting on singular trades where I might be able to make money on this trade or I might be able to make money on that trade. It's about putting together a portfolio. It's about thinking, 5 steps ahead in a marketplace, especially when we're seeing sector rotations like this. It's about planning for the fact that we've already rotated out of the financials, that sooner or later, I think we're actually going to rotate into the financials, out of big tech, and that's precisely what I'm allocated for at this point in time. I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.